And next up, we have a panel discussion to debate the issues facing our economy in turbulent times. I'd like to welcome our panellists and Jack Tame to the stage to explore how to avoid some of the potholes in the road to recovery.
E mihi ana ki te rangi, e mihi ana ki te whenua, e mihi ana ki ngā tūpuna i te pō, e mihi ana ki ngā uri i te awātea, tēnā koutou katoa, ki aore e tiwe ko ara mai, ki te hui ka nohi ki ka nohi. Ki te haukainga o tēnei wahi Ngāti whātua o rākei, tēnā koutou katoa. Ki ngā kai kōrero i konei, haere, haere, haere. Mā ki ngā kai whakarite o tēnei hui, tēnā koutou katoa. Nā reira, kia tātou, kia pai te hui nei, tēnā koutou, tēnā tātou katoa. There are certain words and certain phrases that are banned in good newsrooms. So if you ever read a story or ever watch a story that ends in the phrase, only time will tell, or remains to be seen, rest assured that there is a copy editor somewhere screaming and pulling their hair out. I think after the last couple of years, we can all safely add the word unprecedented to that list. I don't know if you've heard, but these are unprecedented times. Inflation's at a 30-year high, unemployment's at an historic low, consumer and business sentiment is gloomy at best. The OCR is at a 7-year high and climbing. Tens of thousands of mortgage holders are steeling themselves for a rude shift. It is a tough time to be a central banker. It is a tough time to be a mortgage holder. It is a tough time to be a business operator. It is a hell of a time to be an economist. This morning we have some of the best in the business to share their thoughts, insights and expertise on the state of the economy, our sense of direction, resilience, pitfalls, concerns, and maybe even a few flashes of optimism. Maybe. The way it will work is we'll have a bit of a conversation to kick things off. You know the deal. You can send through questions to any of the people on stage, and I'll try and get to those in a couple of minutes. Put a name on it if you want your question directed to someone in particular, and we'll get to that very shortly. To begin things, though, I'm going to start off by asking each of the people here on stage to give us a bit of a back-of-the-envelope picture. So 30 seconds on how you see the state of the economy in September 2022. The only rule is you can't say unprecedented. And I think we'll start down the end there if we can. New Zealand Initiative's Chief Economist, Eric Crampton.
Cool. Doing well right now, but perilously risky. There is going to be a horrible mess coming out of Europe. I'm not sure that government is quite ready for it. I hope business is. The policy risks in there are substantial. They'll have to be nimble to adjust to it, and they are occupied with a bunch of stuff that isn't really helping anything, so that's a problem.
Thanks, Eric. We'll get to some of that in a minute. Sharon, I'm suspecting you're going to take a slightly more diplomatic tone. Only a hunch. ANZ's Chief Economist, Sharon Zollner.
All right, in 30 seconds. This normally takes me an hour. All right, plenty of inflation pressure out there. We think it's going to be pretty sticky, the core inflation. The tradable is going to come back because, as Eric mentioned, there's all kinds of issues in the global economy, not least of which is the Federal Reserve on the warpath. So interest rates rising, even though the growth outlook is pretty rubbish, and that's not a very nice scenario at all. We recently revised our OCR forecast and now see it going to 475. So we've added 3 25 basis point hikes in the first half of next year, just as inflation, because inflation won't come down quick enough. And if inflation's not coming down, then real interest rates are not high enough, and the OCR needs to do the work instead. It's basically a trade-off there, pretty much one for one. So that's our story, and the rest you can kind of guess. A 475 OCR is obviously highly risky for the likes of commercial property, residential property, but overall households are more resilient than you might think in terms of their balance sheets after the spectacular housing boom that we've had.
Okay, we'll look at some of the big picture stuff a bit more in a minute. Next up, though, Craig's Investment Partners Head of Private Wealth Research, Mark Lister. Kia ora.
Thanks, Jack. I think we're going to end up talking a lot about inflation and interest rates in this session because that is what it all comes down to. Long story short, we had the pandemic. Policymakers, whether it's governments, whether it's central banks, in hindsight, did much more than they needed to. Asset prices, everything prices went through the roof. We created an inflation problem. We're trying to unwind that, and that is going to be a really, really difficult needle to thread to do that and not overdo it, not send many economies around the world into a slowdown, well, a sharp slowdown, an ugly recession, something in between. So it's a hugely, I won't say unprecedented, but uncertain, massively uncertain environment. So whether you're a policymaker, a politician, a business person, an investor, it's a very unclear time, which it's not all bad. There are a few bright spots, and I'm sure we'll get to that, but the list of things to worry about is definitely longer than the list of things to be encouraged by, sadly.
CoreLogic's Chief Economist, Kelvin Davidson.
Thank you. I'd add learnings to that list of words that I won't use. But I have a housing lens, so my thoughts around the economy are pretty much to do with housing. So, the housing affordability challenge is obviously going to be, it's a big issue now. Will stay a big issue, especially if interest rates, keep rising. So, we're going to have these debates around home ownership rates. That's obviously a key political issue. I wonder if actually we need to acknowledge that there's always going to be renters. That's just a fact of life. And then so it's about ways of catering to those renters, the right housing stock, other ways to generate wealth. I think that's a part of it. And instead of, maybe the sticks we've had for a long time against property investment, maybe some carrots for other things. So, always that housing lens, but there's challenges.
What I think we'll do is over the next, thanks guys, over the next 40 minutes or so, I'll start off with big picture stuff and then we'll focus in a bit on the housing market because obviously that affects so many New Zealand households, focus in on equities and broader markets as well. So if any of you have anything you want to add at any point, don't sit on your hands, just grab the microphone and say it. I know that's not going to be a problem for you, Eric. Sharon, perhaps we can go back to you. Is a recession inevitable in New Zealand and the US?
It's certainly a pertinent risk, shall we say. In our forecasts, we've basically got a domestic recession, but saved by the recovery in the external sector. So we already saw in the GDP numbers that just came out that an unseasonal arrival of tourists in the winter actually caused quite a flurry of activity. But of course, the main event is the summer, and the forward indicators are looking pretty good for that. So here's hoping we can find the staff to make the most of that. Some of those staff will be those arriving on the planes. The backpackers are a pretty important part of that. But essentially, a lift in activity in that sector is very, very welcome, both in terms of lifting headline GDP growth, but also helping New Zealand pay its way in the world. Our current account deficit has just absolutely it's gone one way. It's now 7.7% of GDP, which is really not respectable at all. We've not been paying our way in the world at all. We swapped an industry that was earning as much foreign exchange as dairy for a housing, something starting with B. You can choose your word, boom or bubble, whichever you prefer, but clearly it was unsustainable and it involved selling stuff amongst ourselves rather than really paying our way. So, a mixed story. There is reason to be optimistic about the benefits of that, of the fact the border's now open again, for sure. But the fact is we've just had a massive housing boom at a time when we were building more houses than we'd ever built before. The population was shrinking and there was a pandemic going on. So quite a strange time in that context. And there will likely be some payback for that. That is inevitable. Whether it tips us into a recession, well, the GDP data is still all over the place. So I think the technical definition of a recession in that context is not very helpful. I think for the person on the street, they would define a recession in terms of unemployment. And at the moment, the unemployment rate is still around record lows, despite a record high proportion of the population, the working age population, putting themselves up for work. So that's a very, very tight labour market and absolutely crucial for the outlook is how quickly some spare capacity emerges in that sector. The Reserve Bank needs it too, but it's obviously a difficult thing for them to talk about because it basically, to beat inflation, they require some people to lose their jobs. That's a comms challenge right there, I would say.
to say the least. Mark, what's your view on the inevitability or otherwise of a recession here and in the US?
Look, it's going to be really tough to avoid, and some would argue the US is already in recession.
Yeah.
The first quarter of the year, second quarter of the year, both negative, only very mild negatives. The Atlanta Fed, runs a GDP now sort of forecast, which is sitting at, I think, 0.3% for the third quarter, and you could easily see 3 negative quarters. So whether that'll be officially called a recession or not, hard to say. But I think the point Sharon just touched on a minute ago is really important. How do you get inflation down when you've got a really, really tight labour market? Here, lowest since the 1980s, close to it. In the US, a month ago, it was the lowest we'd seen since 1969. You've got to cause some pain. You've got to create some unemployment. And historically, I don't think there's been a time in the US in the last 75 years where unemployment's gone up by even 0.5% without there being a recession. So you would say history is not on the side of central bankers who need to create a bit of labour market slack, which is code for cause some job losses to get the inflation down. It's going to be very difficult.
Eric, why don't you talk to us and give us your views on the RBNZ's response so far?
Yeah, it's going to be pretty tough to get out of current inflation rates without generating some hardship. The Reserve Bank built a rod for its own back in the current mess. They went too hard from May 2020. It was appropriate for them to be pretty accommodative because we didn't know fully the nature of the shocks that we came through with COVID. But they were fundamentally using demand-side measures to deal with a supply-side problem. It should have been modeled as a negative technological shock rather than a traditional kind of Keynesian demand shock, and they failed to reverse course nearly quickly enough. What would be more helpful would be if we think back to Minister Robertson's talk earlier, and he wanted to avoid dangerous austerity. Well, you're running a giant, you're spending an awful lot of money, positive fiscal impulse, deficit spending while the economy is insanely overheated. That does not make the Reserve Bank's job any easier. It means that their interest rate response has to be even harder than it would have been. And while the Reserve Bank has almost doubled in size under Orr, they have not boosted capabilities in the economic side. It's all been on other stuff. So you worry about core competence, their ability to navigate incredibly difficult times, having shed a lot of economic expertise, and not having been helped on the Parliament side. This isn't just COVID stuff. They are still running make-work programs that they had designed in mid-2020, like EnviroJobs. They're still paying people to do that stuff on premise that we need to be making work, right? And we've got labor shortages. It's nuts.
I'll just jump in there on that point about housing and the way that house prices have gone up. Got to recall that it's a kind of zero-sum game. I think it's a really important point about we don't get wealthier by just buying and selling each other's houses. And I guess that's the thing about post-COVID is the distribution, and for government policymakers is, I suppose, some ways the rich have got richer and the poor have got poorer. So it's, I think, acknowledging that, housing is kind of a zero-sum game. Yes, there's the confidence effects of the wealth effect that everyone talks about, but that distribution is quite important to acknowledge and probably has implications for what happens next.
Kelvin, what will be the full impact of those interest rate increases once they're all through?
I think a lot hinges on the unemployment rate. We're seeing now households are already facing a lot of repayment stress. Mortgage rates have gone from 2.5 to 5.5, something like that, with perhaps a bit more to come if the OCR forecasts are right. So, but it kind of seems like, maybe the effects are lagged, maybe, but it seems like people are adjusting to the new norm. So I think a lot of it hinges on the unemployment rate, and that's probably been a key thing that we've talked about already.
Yeah.
So I think that's holds the key.
Does anyone have a magic number? Because I suppose there are three factors at play, right? We have monetary and fiscal policy. You also have the international factors that we'll perhaps touch on in a moment, Eric. But is there a number for where unemployment needs to be to get back to that targeted range for inflation, Sharon?
Well, the Reserve Bank published a forecast of 5% in their last monetary policy statement, so I think it's quite reasonable to interpret that as their current best estimate of what they think they need to see. It may or may not be right, but if that's what they are implicitly aiming for, unless we get some nice downward surprises on inflation, then I think that's probably your best ballpark number.
Mark, do you have a view?
No, look, I think that's a reasonable, you've got to sort of the central bankers are driving the ship at the moment, aren't they? And I think the outlook is, in a big way, a function of how they operate. So you've got to hang your hat on whether it's the RBNZ or the Fed or whoever, what they're saying. But, to me, going from 3.3% in the March quarter to 5%, it's quite a big move. 5's still low in the context of history.
Yeah, and
but
their
when you started
forecast
at 3.3.
Yeah, and their forecast that rise is almost as rapid as when the GFC hit. It's a pretty fast lift, even though, of course, they're forecasting it to then stop and not carry on like it did. It's a bit like a wildfire, though. you try and stoke a slowdown or a housing lift, and it's likely to go further than you intended.
Yeah, perhaps we can talk a little bit about some of the international factors at play, because I think we're going to work up to a question for all of you, which will be, what's it going to take? What's the magic bullet to get inflation back between 1 and 3? And we can get to that in a few minutes. I appreciate there are myriad things that are going to have to go right to get us back to that point. But Eric, talk to us a bit more about some of the international factors at play at the moment, because the Northern Hemisphere is heading into winter, which means that Europe is going to face all sorts of shocks on the energy front, and is already starting to face those. I saw the morning shows, the breakfast shows, just before the Queen died in the UK, running a Wheel of Fortune type competition to either win a couple of £1,000 or your energy bills paid, which, just seems dystopian in modern Europe, but there you go.
Yeah, in one sense, we're lucky because normally we'd say it's just terrible that our energy markets aren't well coupled into international markets. You would want to have our natural gas that's getting internationally priced. Right now, pretty lucky that it's not, right? So because there isn't ability to export that stuff, it faces a much lower price here, so we're insulated from some of these problems. But if some numbers came out earlier this morning, the producer price index in Germany, I think it jumped up by 46% year on year. Just imagine if producer prices here had increased by almost 50% year on year. Like, that flows through into everything, and it's because of energy, and I don't know what breaks first in Europe, whether it's businesses shutting down because they cannot afford to operate under those electricity prices, which will mean that we're screwed on a whole pile of materials that we rely on in supply chains because they can't make them anymore in any economical fashion. First prices go up, demand goes down, and things start blowing up. Or whether political resolve on Ukraine breaks and they try begging Russia for gas, and I hope it doesn't go that way. Or whether you have political collapse. You're getting into crazy numbers on energy costs and heating costs going into winter, so that could be very bad. The worry that I then have is that over the past couple of years, we've had a tendency from government to have sort of knee-jerk responses when there are crises that come up. We had some very good crisis management in March, April 2020. I can't fault much of what was done then. More recently, you see a gas price hike and you get a petrol excise rebate that's funded out of COVID funding rather than buying masks for school teachers, right? So it's that kind of fragility here on the policy side where when things go nuts, they try and find something that can quickly be seen to be addressing the problem, and that can have its own set of risks.
Do you think government is reconciled with the state of the energy markets in Europe? Are we prepared for this northern winter?
How do you even start thinking through it, right? Businesses should be looking through their own supply chains to what am I relying on? Okay, I'm telling people how to suck eggs here, right? You guys know this stuff better than I do, but I would expect that people will have already looked back through their supply chains, figuring out, okay, what am I not going to be able to get when power prices in Europe are 10 times what they are now, and those factories shut down? I hope that they're stockpiling on some of this.
Sharon, can you talk to us a little bit about the role that China's playing in all of this? I think we've got a party congress in a month or two's time, which might mean some significant policy changes when it comes to the zero COVID approach that China is still pursuing.
Yeah, no, China saved our bacon and Australia's as well in the global financial crisis. They were hit hard by a loss of export orders from the US, so they just went on a massive spending binge. Their ability to do that again, I think, is somewhat hampered. They've got their own debt issues and structural issues. I think, unfortunately, they've got a couple of things going on. One, as you mentioned, is COVID zero meets R zero, and that's not going well for them. They're basically playing whack-a-mole, and they don't seem to have a long-term plan. That means keeping their border closed, which cuts them off from the global technological frontier, and obviously heightens geopolitical risks as well. They've also got a long overdue shakeout in their residential property sector, which has long been used as, shall we kindly call it, a lever for manipulating GDP growth to be where they want it to be. But the more you muck up people's incentives, the bigger the mess, and some of that's coming home to roost. Just one of the property companies that's got into serious trouble, Evergrande, their debt is bigger than New Zealand's GDP. So the scale of this is enormous. I don't think the Congress, presuming Xi gets back in again, which seems to be a given, I don't think that means the end of COVID zero, because he's tied his personal brand to it very, very closely. So I don't know what the end game is there. They won't admit that their own vaccines are not as effective as the mRNA ones. So it's not like the Auckland lockdown where we used that time to buy our way out. They're just playing whack-a-mole, and the cost of it. When they go into lockdown, you don't get this nice 48 hours kind notice, please get yourselves home and stock up. It's just like your door is shut, and good luck to you. It's pretty brutal and a very difficult environment to run a business or even just your life.
I'm not trying to put your geopolitical analytical skills on the spot too much here, but is there an alternative world where we might feel optimistic that if she gets through the party congress at the end of this year, that maybe the zero COVID approach might have been more about control than anything when it comes, any practicality when it comes to the economy, and that restrictions might loosen somewhat?
For that, you need to have a decent rate of vaccination with an effective vaccine. There is no path of gradual loosening that doesn't quickly go exponential and just run over your health system at the moment. And so, unless they're going to start developing mRNA vaccines or importing them, I don't see a road out. The social unrest that would come with the death rate that would be associated with just letting COVID go now. Yeah, some countries have been there, done that. Not many political leaders survived that process.
No. Mark, do you have anything to add?
No, look, I think China's obviously been great for New Zealand in recent decades, but we have hitched our wagon to that story, haven't we? They're our biggest export market. Our second biggest export market is Australia, and Australia's biggest export market is, so, we get the double whammy. When you get a slowdown in China. And over the short term, China looks troubled, whether it's property, whether it's the COVID stuff, and they should just start using the Moderna vaccine or something. They've got droughts, that's also causing them issues. So in the short term, challenges. In the long term, I still think it's not a bad place for us to be. Still a very big economy, a growing economy, but it's also our biggest risk. You think about the what could go wrongs in a long-term perspective for the New Zealand economy. It's things like foot and mouth, and it's just this fact that we're kind of a one-trick pony. Growing grass, making it to milk powder, sell it to China. Something going wrong either from the geopolitical perspective or otherwise. So it still makes us vulnerable, that reliance, in a long-term sense, I think.
And when it comes to Europe, is there a danger we underestimate the impact of the war in Ukraine?
No, I don't think so. It's largely been felt for us through commodity prices because Ukraine and Russia are just such big producers and exporters. In a morbid sort of a way, we benefited from that earlier in the year when dairy prices rose. So I think there's positive spin-offs there. It's still a really tough situation to call. Geopolitics is incredibly difficult to predict, especially when you've got a guy like Putin involved. I feel like the gas situation, it's a bit of a game of chicken. Eric's points are correct, but I think Russia can mess with Europe for 1 or 2 years, but they also would find themselves in a risky position because I think Europe's sort of 75% of the demand for that Russian gas, so they're losing however many tens of billions it is while they're not shipping it, and they haven't really invested in the infrastructure to pipe it somewhere else, and they don't put it on ships, so they're at risk too, which hopefully means that there's a time frame on all this. But look, you got to add that to your list of issues, don't you? So it makes for a really difficult forecasting environment.
Okay, let's talk a little bit more about the central bank response. Kelvin, if a big part of the inflation problem is the international uncertainty, ANZ's forecasting the OCR peaking at 4.75, but if supply chain issues, the war in Ukraine, China's shutdown is causing a lot of the inflation we're experiencing right now, what will a higher OCR actually achieve?
Yeah, I suppose a big question. I mean, there's the impact on the housing market too being uncertain around this whole idea that things are already priced in. You hear that phrase a lot. Well, OCR goes up, doesn't matter for mortgage rates because it's already priced in. So I think that applies in lots of different ways. If people are kind of anticipating it, what you need is things to turn out differently than what they're already anticipating. So, there's lots of those knock-on channels. I think, given my housing perspective, I think given housing such a big part of our wealth and our economic activity, I think what we'd really need to see is things going beyond what people are already expecting, and so people are already anticipating some degree of inflation, some degree of further interest rate increases. Maybe we're ahead of the curve here, but we'll take that change, or take the surprise factor. But I just also point out around inflation, I'm kind of waiting for the Reserve Bank to come out and say, hey, let's just be clear about what inflation is, because I get the sense that there's a bit of confusion out there between the level of prices and inflation. Inflation's the rate of change, and so it could be that actually in the next little while, we start, might not be for a while necessarily, but we start to hear commentary about, well, inflation's coming down, don't worry, it's all under control. That could still mean a high level of prices, and so that, there could be a degree of confusion out there. People are like, "What? Still costs me $3 for a litre of petrol," and yet everyone's saying, "Don't worry, because inflation's coming down." So. The communications issue for the Reserve Bank was talked about before. That could be another part of it, which I'm kind of waiting to see, is hey, inflation's different from the level of prices. But lots of different angles.
Mark, I'll throw that question to you as well. If the international tensions, supply chain issues are causing a lot of the inflationary environment we're experiencing right now, how does a higher OCR actually help?
Yeah, no, that's a really good one. Jack, I think it was the San Francisco Fed in the US did some work trying to estimate what part of the current PCE inflation over there is supply side and what's demand side and what's sort of unknown. And I think that their best guess is that the supply side issues are 50% of it. The closed factories, the logistical challenges, the supply chain issues, what's going on in China, and how does raising the OCR or the Fed funds rate or the Bank of England cash rate reopen a Chinese factory or make a shipping line sort of open again? It doesn't. So interest rates are a pretty blunt tool. You can raise them and you can cause us some pain and make our lives a bit harder, reduce demand and hit that part of the inflation problem, but you've still got those supply side issues that are causing you grief, and that's something the central banks don't have much control over at all. We've just got to hope that those issues start to ease.
Okay, Eric, we're going to unleash you.
Oh, sure.
From a regular... Oh, sorry, you got something to add?
Oh, just on that. The domestic component of inflation has been pretty high. So since I've moved here, it's been... Whenever I looked at the CPI, domestic factors are normally running north of 3. Tradable inflation is normally what's keeping us within bounds. Now international isn't helping, so Reserve Bank has to work harder. Now you're right that interest rate moves can't do anything about supply chain pressures abroad, but if the bank is forecasting over the medium term, some of that will just get looked through, right? Because if you've had this crazy stuff happening on supply chains, if that doesn't change, then that's a one-off change of the price level. It's not ongoing inflation. So then year on year, once it's worked its way through, it's not ongoing increases. Hopefully, they are on top of the forecasting on all of this, that they get that right. But it takes it's beyond my ken. I'm a microeconomist.
From a regulatory perspective, what is your assessment of the government's last 12 months?
Well, it's been a bit disappointing. So there have been a lot of these knee-jerk responses. I was interested in the prior talk around outcomes-based sorts of assessments on FMA issues. If we think back over the last year of CCCFA and all of the problems that the sector very well telegraphed to the government, this is exactly what's going to happen if you proceed with this. And then the government proceeded anyways, and then people weren't able to get mortgages anymore without documenting every time they bought a chocolate bar. Then they say, oh, well, we've learned from this, and we're going to try and ease some of it. We can't keep running this way. So further on knee-jerk responses, we had an excellent panel just earlier talking about sort of climate commitments. I didn't hear the word emissions trading scheme come up once. And that's a big problem because that should be the underlying thing that is driving our carbon response. Higher carbon prices make firms change their investments. They look forward. They see that coal doesn't make sense for a lot of stuff anymore. They change what they're doing. Now, the problem that we get with it, getting back to policy, is that government thinks that it needs to do stuff that is very visible on top of the ETS, which will not have much effect on greenhouse gas emissions and just puts us onto higher cost pathways. So that kind of policy fragility is a problem. We don't know what messes will yet come out of what's going on in Europe that will cause other unpredictable responses. And we can also look at, this will be one that will be perhaps dangerous for the sector here. Look at what happened with the supermarkets and the Commerce Commission inquiry. It would be surprising if we didn't get one in insurance in the next couple of years. If you look at the process for supermarkets, the executive teams of the main supermarket chains were tied up for about 4 months doing almost nothing but wrestle with ComCom issues, and eventually ComCom comes to the right answer in the final report, and then Minister Clark just throws it out and says we want to break up the supermarkets and force access into the supply chains. These kinds of regulatory risks are substantial. They seem fundamentally populist, and populism is a response to uncertain, dangerous economic times. So all of this has me really worried.
Thinking ahead to the election then, next year, I mean, there are going to be significant political pressures, especially because at the moment the polls are suggesting it's likely to be a toss-up. What government do you think would be better for the economy, Mark?
I knew you were going to throw that one at me. You didn't invite the politicians, they're not here, are they? No. Look, hard to say. I think if there was an election today, I think there's a good chance you might see change of government, not by a lot. So, how it plays out next year, I think a lot of it will come down to the outlook. If you get a rough economy, if you've got an OCR at 4.75 and a Fed funds rate of 5, then you probably, that's not great for the incumbent. Who's better? Look, I am a bit of a political cynic, and I don't see daylight in terms of policy between the two major parties here in NZ. I kind of feel like they both like to hug the status quo. Neither of them are really brave enough to go for major change or sort of attack any of those sacred cows like, the tax base or, retirement savings, retirement age and that sort of thing. Historically, it's been Labor governments that have always been better for the housing market, for the share market. I don't know if that talks to their economic management or if it's just the way it's panned out. But, for me, the migration settings are maybe the thing I've got an issue with most. I feel like we haven't got that right, and that's feeding into the unemployment, the lack of staff that we've got, the inflation issues. So I want to see someone deal to that.
What would a better migration setting look like then? Because that's a question I have for all of you.
I don't know. One that gets more people into the country. One where I can go to Queenstown and there's actually fully staffed, bars, restaurants and hotels. And one where sort of every business owner right up and down the country doesn't talk to me about the fact that they are struggling to get people in here. So I'm not a policy analyst, so I don't know sort of what we're not doing right, but there's something we're not doing right.
Well, I guess there's a global competition for talent. I mean, we're not the only ones with the tight labour market at the moment, and I guess it's the question is not necessarily how low do you go in trying to incentivise a stronger migrant workforce, but it is a question about what other incentives might be available or how you tweak those settings. Sharon, do you have any thoughts on how our migration settings are sitting at the moment?
Well, I think the government's quite concerned that they let in a flood of workers just as the economy goes into recession, and the unemployment rate ends up going much higher than it would have needed to otherwise. So that's a valid concern. The Reserve Bank in its monetary policy statement has basically pointed out that immigration is ambiguous in its impacts on inflation. It would boost labour supply, but it would also increase housing demand and other goods and services. So that they've said they won't respond to a change in net migration. They'll wait to see the impacts of it and respond to that. So it's not a quick fix in that regard. But it would also say that, of course, it looks like a supply problem for a firm that puts out an ad and doesn't get any applicants. But when you step back and look at the economy, it's a demand problem. It's a massively overheated economy, and the Reserve Bank's on the warpath trying to reduce that demand, which will reduce labour demand. So I would just be wary of attacking a demand problem with a supply rush because of what the other side of that might
Right.
look like. So there is a balance to be struck. I think everyone in this room would say nurses should be on the green list. The concern is that if they get residency when the minute they arrive, they'll just take off to Australia. But that is a valid concern. But the thing is, if we don't give them residency immediately, they'll just choose Australia first up. So I'm not sure there's a trade-off there.
You're damned if you do, damned if you don't.
Yeah,
Kelvin.
I was just going to add that as well, that, it's kind of like the OCR point, like, is it doing anything? Kind of the same with migration policy. I mean,
Yeah.
if, you can tweak the levers, change your quotas, whatever, but if Australians pay 30% more and I'm sitting in wherever, India, going, hey, should I go to Australia or New Zealand? Sure, there's other factors, but 30% more in Australia is looking pretty... And what's the government going to do about that in a 2 or 3 year horizon? So, there's probably a limit to what can be done,
Eric, do you have some thoughts on that?
Well, policy could be a lot better, right? So I take your point entirely. Wages are more attractive in Australia, but we're doing a lot of stuff here that other places aren't. So, and for the worse. So you talked earlier about the global competition for talent. I'm not sure that New Zealand is even trying on this one. For the past several years, it has felt like government kind of hates immigrants, that they view them as stealing Kiwis' jobs and stealing Kiwis' houses. So first they're trying to count the number of Chinese-sounding names at house auctions. Then they're... It's not been friendly, and it's a big contrast. It's not a national labor thing. I moved here when Helen Clark was Prime Minister, and I'd just gotten my green card in the US, gave that up to come here. Just the difference in approach, it was wonderful. You could live here as a skilled migrant and not be treated like crap. The changes that have come in over the past 5 years, where it's not going to be easy to live here unless you're on a residence visa. You're not allowed to buy a house. You can't live normally because of some of the immigration policy settings that they've made. At the same time, the bureaucracy has collapsed in part because of the changes that came in with COVID. So they shut down some of the overseas processing offices because, what's the point, right? You're not going to be able to come in because we've got the closed border. But they've not been able to scale it back and then back up. And rather than pursue a sensible approach on the general grant of residence for people who are here through lockdown, they've had a high paperwork approach to it, which has meant that they've not been able to clear the desks over at the Immigration Service. So there's still delays in getting these things processed. So sure, we've got these problems in lower wages relative to Australia, but the policy settings where we kind of expect that migrants are going to just be dying to come here and will be begging us to let them in, and instead we treat them like crap, it's not going to work. We should change that approach. Migrants don't steal jobs. There isn't just a lump of labor.
I want to focus on two things. Equities in a moment, Mark, but let's start off with housing. Kelvin, where will the housing market end up when compared to the COVID peak? What's your best
compared to the COVID peak? So it went up about 40% post-COVID over that sort of 12 or 15-month period, come back maybe 10%. I reckon, it's the sort of $1 million question, and maybe we've got another sort of 5% to go from that peak. So, rough maths, you're kind of still 20% ahead of where it was. So, that's there's a distributional thing there as well. It's just got simply harder for would-be first-home buyers with some wealth on paper at least created for homeowners. So, yep, we're still going to be up compared to where we were pre-COVID.
Right. Sharon, where do you see it going?
Yeah, there's a general consensus around that minus 15 number. It's a good round number, so it's bound to be wrong. But in real terms, we've got house prices going back to where they were before COVID. So essentially that COVID bump unwinding. So that's important. Because it's the general wage and price level, it's a dirty little secret, but it can really get you out of a corner that you've painted yourselves into, whether that's your level of government debt or, in our case, the relative price of housing. Basically, the general wage level has done almost as much adjustment as the nominal house prices has done. And that form of adjustment doesn't put people in negative equity and get your banks in trouble and all that sort of thing. So it is actually helping us out quite a bit. I'd also think it's worth noting, separating the channels through which higher interest rates work. There's the impact on house prices depends mostly on the hit to borrowing capacity. And if wage growth is higher than expected, that goes a long way to actually offsetting that, and which is part of the reason we think the OCR has more work to do. That's also instant. So we're sort of 90% of the way through that. So there's actually risks that house price falls could peter out before they get to minus 15. There's obviously risk it could go further if unemployment rate rises, but that's not a one-way bet. But the impact on household spending capacity is much slower because of the fixed rate mortgage thing and the fact that heaps of people are still sitting on a mortgage starting with a 2. So that drag on consumption is going to just keep on growing. And in our forecast, that's why we've basically got a domestic recession. Consumption falling as a proportion of GDP pretty consistently. So those two channels are quite different, and the house price channel is much quicker and probably much more through its course.
Right. Kelvin, at the very start you touched on some of the tensions around the rental market. How do we efficiently supply rental housing in the future whilst at the same time encouraging property investors to perhaps diversify more than they have historically in New Zealand?
Yeah, well, I'm reasonably optimistic about that, actually. I think we're going okay. You know, just simply look at what the private sector's been doing. We've already been churning out, 35, 40,000 houses a year. Consents are higher, but, consents don't always translate into houses, and we're knocking stuff down. So, the private sector's actually been doing a pretty good job. Now, you might say, there's been the right incentives, right or wrong. There's been some incentives there in terms of the LVR rules and the tax changes for investors to get in there, owner-occupiers to get in there. So, but I'm reasonably optimistic. I mean, build to rent to me seems to be a pretty damn good idea. What I didn't say earlier was that, in terms of more people renting and why that's not necessarily a bad thing. I mean, look at, say, Germany, look at Switzerland. More than half households there rent, and they're not poor countries, So, but then I think it's about the right type of housing. It's about the right type of other investment options.
Yeah.
So, I'm reasonably optimistic. I mean, there's some forecasts out there, obviously, for the construction sector to slow down. So that will, reduce the potential supply of rental property. But hopefully, less of a slowdown than we've seen in the past. So, there's I'm reasonably optimistic. Now, could National come in and reverse some of those tax changes around investors into property? Well, of course. But actually, if you look back through history, the track record of governments coming in and truly changing things is maybe a bit limited. I'm sure there's been some examples, but there's a difference between saying it now and actually doing it later.
Mark, let's talk equities. Everything's down this year. Shares, bonds, houses, crypto. Is that unusual, and is there anywhere that investors can hide at the moment?
It is unusual. Usually you have one of those asset classes doing okay. Generally, you think back to GFC, you think back to the COVID period, you think to other times in history when there's economic trouble. If the risk assets are doing badly, houses, property, shares, businesses, if they're doing badly, then bonds are probably going okay because reserve banks are reducing interest rates to, shore things up. But we are in a period that we haven't seen for a while, and that's obviously because of the, the U word that we won't talk about, and what we saw in 2020 and 21 in terms of stimulus. So it's a really tough environment, and I don't think there's any silver bullet. You can sit on cash in the sidelines and your money's safe in the short term, but when inflation's 7 or 8%, you're still underwater, so it's not a long-term strategy. So, look, it's definitely a time for playing it safe, being cautious, hedging your bets, being well diversified. I think for investors, periods like this, recessions, they're normal, they're par for the course, and I always tell people that if your investment time horizon is any less than 10 years, then you shouldn't be in shares or businesses anyway, because it's too short a time frame. So, as long as you've got that long-term mindset and as long as you're getting good advice or getting looked after by your fund manager or whatever, I think in the long term you'll be fine. You'll probably do okay, actually. You look back through periods of uncertainty, whether it's, the GFC or March 2020, and those are actually the good vintages of putting money to work. So hopefully this time will play out similarly. But from here, it feels like there's still a little bit... things will get worse before they get better.
I'm heading to the States in a couple of weeks for a wedding, very excited by it. My girlfriend went to book a hotel in New York City the other day and got a rude surprise. The New Zealand dollar's, sub 60 still. How low might it go?
I feel your pain there, because I went for my first US trip in 2009 when the Kiwi was at 49 cents, right in the thick of the GFC, and it's ugly. It's at 59 now, so that's the lowest since late 2009. Look, that's Sharon will definitely have some thoughts here. That's good for us in lots of ways. Makes our exporters more competitive. Good for the farming sector. US shares are down 20% this year, but in New Zealand dollar terms, they're only down 6 or 7, so it's been great for investors in international assets. Probably not helpful for our tradables inflation, and at some point it'll reverse, but Sharon will have a forecast of where it's going in the next 6 months, I'm sure.
Yeah, no, but I think the upshot is the New Zealand dollar shouldn't take it personally. The US dollar is just running over everyone. And that's because they're benefiting from both the fact that the Federal Reserve, as I said, is on the warpath. By this time tomorrow, their cash rate will be higher than ours after they started well after us. So it's basically gone completely vertical. So that's obviously sucking money in. As well as that, they're the world's safe haven for lack of alternatives. So I can't see much that's risk-free about US government debt, frankly. We're all very nervous about the next election, among other things. But yeah, those are massive trends that it's hard to see turning around anytime soon. So yeah, you might want to choose somewhere else for your next holiday.
Yeah. We've only got 5 minutes to go, so I'm going to go to a couple of questions from the floor, and a very, very difficult question. So if any of you want to answer this, please, kōrero mai. Is there any good news?
I've got some good news. Happy to be sort of the resident sort of glass half full. Look, oil prices are off 30% from where they were in June. You know, they're back below the levels, you know, we're back where they started the year, before the Russian invasion of Ukraine, and that's been a big component of inflation in lots of parts of the economy, so I think that's a positive. Some of the leading indicators are telling us that there might be some bright spots. You know, you look at some of those US sort of surveys, whether it's small business surveys, pricing intentions for firms are way down. That's been a good leading indicator about inflation going up. Maybe it'll be the same on the way down. Supply chain issues, you know, the ISM index has a supplier delivery times, low, you know, that's come way down. Even the ANZ pricing intentions, I think it's the lowest since maybe late last year. So things are moving in the right direction. And you know, I'm confident that these interest rate hikes, which have been phenomenally fast, you know, the Fed's moves in the last 6 months, we haven't seen a move that aggressive since 1983. So they will work. It's just how much pain sort of we suffer along the way, but hopeful.
Yeah, following on from some of the prior discussion around the rental market doing all right, the government has gotten a few things right in this area. So the MDRS standards, the NPSUD, freeing up a lot more land for building housing, combined with some of the neat stuff that's flowed on. I talked before about problems in the Commerce Commission study on supermarkets. If you look at what they've done in building material supply, and then what the Kanga Ora and the government are doing around that, and trying to make pathways through for getting other building materials in to make it easier to get more buildings built, all of that is to the good. Could be a little bit optimistic on that. They still don't have the incentives around councils, right, to make them want to have more growth, but they have freed up some of those constraints.
Sharon, ANZ obviously does regular sentiment surveys. What will it take, do you think, to improve sentiment both for consumers and firms?
Well, the problem is that if you, in fact, we are seeing that. It's looking like the trough of business and consumer confidence was a couple of months ago. So, yeah, that's great news unless you're the Reserve Bank and you are actually trying to reduce people's spending and their investment, and you're trying to make them scared. So from where they sit, that's not good news. It's a sign they need to do more. So we had a long period where bad news was good news, because it meant that central banks would cut rates and print more money and equities would keep going to the moon. Now we're in the symmetric situation where good news is bad news. It was inevitable, and here we are. But I want to have come up some good news, but it's selfish good news, and it comes back to that point you made about food prices. Where the inflation will go is obviously uncertain, but I'm more confident in saying the relative price of food is likely to continue to increase, and we're one of very few countries in the world for whom that is good news.
Right.
So we've got a pretty natural hedge against energy prices. We're not Norway, but we do have a bit of a hedge there, and that's pretty valuable.
We are almost out of time, so I'm going to ask each of you perhaps to cast your mind forward over the next 12 months or so. Give me your best guess, your best forecast as to how things might be sitting in 12 months' time. Eric, can you kick us off?
Well, 12 months from now, we're going to be into election period, right? Okay, I don't have any crystal balls, and I certainly don't have any macroeconomic forecasting expertise. I am hopeful that we are able to avoid the worst possible knee-jerk responses on the messes that will be coming from external pressures and from some of the stuff that we're hitting domestically. I'm not a 40% chance we wind up with that. I am more worried that we lock in some pretty serious damaging responses that are hard to unwind. So if we think about things like the oil and gas ban in Taranaki, if a government wanted to change that, they can't change investor expectations about what expropriation. If Clark breaks up the supermarkets, we can't change expectations for international investors about the security of property rights. These things really matter, and they worry me.
Sharon?
Yeah, so in our forecast in 12 months' time, we're a good way through this unpleasant but necessary process of starting to pay our way in the world again, which involves better exports in terms of tourism, but also less spending. And I think, as a nation, we have spent beyond our means for a couple of years, and there has to be a payback from that. But our forecast is that stays orderly, the wheels don't fall off, that our exporters do okay, because, we sell food, it's a necessity. But yeah, grumpy, I would say, probably still, and that feeds, interestingly, into the election cycle.
Yeah. Mark?
Look, I think inflation will be on its way down, but not as quickly as we would all like. I think unemployment will be a little bit higher, but the wheels won't have fallen off completely for all the reasons we've talked about. Share markets, housing markets, they'll be lower than that. They'll have stabilised, but they maybe will have fallen a little bit further than where we're at. And I think you'll have maybe central bankers that will have given up on all the really, really tough talk and just maybe moderated some of those views, which will hopefully allow us to come out the other side in a better way.
Kelvin?
So we're out of time. Very, very quickly, I think recession avoided and house prices will have stopped falling. How about that?
Right, here's hoping. Thank you very much. Eric Crampton, Sharon Zollner, Mark Lister, Kelvin Davidson, please. Ko mai te paki.